I haven't paid payroll taxes in a while. What should I do? That's the question that is the topic of today's video. Hi, my name is Darren Mish, and I'm a tax attorney with a national tax problem resolution practice based in Tampa, Florida. During my 15 years of practice, there are certain questions that are asked again and again, and so I thought I'd take this opportunity to make these videos to answer some of those questions in this video format. Now, there's over 20 videos altogether, and if you'd like to have access to the other 19 videos, please visit our website at getirshelpvideos.com. Now, what do you do if you haven't paid payroll taxes in a while? Well, it kind of depends whether or not you have a revenue officer involved in the case or not. But we're going to just go ahead and assume that no one from the IRS at this point has contacted you regarding your payroll taxes. Now, you see, it's partly the IRS's fault that these payroll tax problems can get so big. You see, very often it can take a year, 2, 3, or even 4 years before the IRS notices that you're not filing your Form 941s and you're not paying your payroll taxes on time. And so it can spiral out of control very quickly. But I would say my number one piece of advice for people that are having or experiencing payroll tax problem difficulties would be you need to get current immediately. What does that mean? Well, it means that you need to go ahead and start making your regular tax deposits on time. Now, there are certain depositors that are monthly depositors, there are certain depositors that are weekly, daily, and I think there's even depositors that have to make more than one deposit a day for their payroll taxes. But I would guess that the most people that are watching this video are either monthly depositors or weekly depositors. So you need to start making your deposits on time. You see, I talk to lots of small business owners, and they say, "Well, you don't understand, Darren. I can't pay my payroll taxes because I can't hardly make payroll as it is, or I can't pay the expenses as it is." Well, I know this is harsh, and I know you don't really want to hear this, but if you can't pay your payroll taxes, then you can't afford to stay in business. So what can you do? Well, you can cut staff, you can cut employees, or you can cut some other area of your business. But if you continue not paying or failing to pay your payroll taxes, bad things are going to happen to you. I promise you that. It's not me that's going to do it, but the IRS is going to come down on you like a ton of bricks. I need to explain a rather complex principle, and I don't know if I have time in this video, but here's a try, okay? I want you to imagine a circle, a pie, or a pizza. And we're going to cut that pizza down the middle. Not quite fairly. There's going to be a small half and a big half. So I want you to imagine in your mind a pizza where it's cut, where maybe one side is 60% and one side is 40, or 65-35, something like that. Now this large half is going to represent the employees' FICA, Medicare, and unpaid federal income tax. Let me say that again. The employee, as you know, in a corporate setting, pays half of the FICA, so that's the Social Security, half of the Medicare, and all of the federal income tax. Now on the smaller half, that is actually the employee's matching portion. So that's half of the FICA, half of the Medicare, and all of the unemployment tax. Now this larger half, remember that goes back to the employee's share, that is actually called the trust fund portion of the tax. Why is it called that? Well, it's called the trust fund portion because that's what the employer holds in trust for the U.S. government and for the employee to a limited extent. So they hold that money in trust in theory, and then they turn it over in the form of their normal deposits for the benefit of the government and the employee. Well, when you fail to do that, what you've done is you've violated that trust. Now you have a trust fund problem, all right? So if your business were to go under, for example, or if the business just fails to pay and the IRS catches up with you, the IRS is going to go ahead and assess that trust fund amount, so that's 60, 65%, something like that. It's hard to define exactly because it varies in every case, but that trust fund amount they're going to assess against responsible individuals. Who does that mean? Well, that means the people at the top, the people who make the decisions to hire or fire, the people who decide to pay vendors instead of the IRS, the people who sign checks, the people that sign 941s, the people on the bank signature cards. There's a whole laundry list of criteria, but it basically means you if you're a single person, corporation or a limited liability company. So they're coming after you. So it's something that's very important to know. You need to get current with your taxes. If you can't get current with your payroll taxes, this problem will spiral out of control and it will never, ever end. It just spells disaster if you don't get current. Now, interestingly enough, if you make payments, voluntary payments out of the goodness of your heart to try to catch up with your back tax problem, the IRS is going to designate those payments to pay the non-trust fund portion portion first. Why is that? Well, because that's what's in the best interest of the government. See, they'd rather have you pay the non-trust fund portion off first, because in the likely event that you can't afford to pay it all off, they still can come after you as a responsible individual. By the way, that the imposition of that trust fund obligation on you is called the trust fund recovery penalty. And we'll probably do more videos about that in the future. But what you can do if you know that you're in trouble and you have some money to throw at the problem while also being current, you're going to want to go ahead and designate those payments to go toward the trust fund portion of the total tax obligation. That way it comes off of the corporation's overall obligation, but it also comes off of that portion of the obligation that could ultimately you could be individually held responsible for. Most payroll tax problems work out being installment agreements. In-business offers and compromise don't usually work, and there's some rationale behind that, but the IRS has a strong public policy against making deals with companies that don't pay their tax roll or their payroll taxes. So most companies end up in installment agreements when they have payroll tax problems. And my rule of thumb is that most of those installment agreements are going to have to pay out within 2 to 3 years. Sometimes it can be longer, but I would say that that's a fairly accurate depiction of the situation. Payroll tax problems can be extremely complicated, as I'm sure you just noticed from this rather technical video. And that's all the time that I have for today. If you want to see more videos about IRS problems and how to solve them, there's actually 19 more, and I suggest that you visit our website at getirshelpvideos.com.